If I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver because that is the, if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, well, if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation.
Silver's recent sharp rise has captured the attention of investors and analysts, marking what many believe could be the beginning of a major rebalancing in the precious metals market. This surge coincides with a notable decline in the gold-silver ratio, a key indicator that historically averages around 50, but has recently peaked near 120. The ratio's fall signals silver moving closer to its long-term fair value relative to gold, suggesting a fundamental and sustained recovery rather than a fleeting spike. Alasdair Macleod, a leading expert on precious metals and monetary history, explains that this shift reflects broader market awakening to the undervaluation of not only silver but also other base metals, which have been suppressed for decades by fiat currency regimes and artificially low interest rates. Macleod highlights the historical context behind these trends, noting that the suppression of precious metals prices began in earnest with the US dollar devaluation in 1934, when the gold price was fixed at $35 an ounce, a rate maintained until the gold standard's collapse in 1971. Since then, the continuous expansion of unproductive debt and the abandonment of gold-backed currency have eroded purchasing power and distorted commodity pricing. In this environment, metals such as silver and copper, while still primarily used as industrial metals, are increasingly being valued in light of monetary instability. Macleod emphasizes that traditional commodity analysis, which focuses on supply and demand, misses the larger picture. The real driver is the decline in faith in fiat currencies and the inevitable normalization of metal prices. Looking ahead, Macleod warns that inflationary pressures will likely continue to erode the value of fiat currencies, pushing bond yields higher even amid slowing economic activity. This environment sets the stage for stratospheric gains in silver and other metals relative to gold and fiat money. While investors often focus on short-term economic indicators, Macleod advocates for a long-term perspective rooted in monetary history and currency cycles. As faith in fiat currency wanes, precious metals are poised to reclaim their historic roles as safe havens and reliable stores of value, signaling a potential shift in the monetary regime shortly. Whether this transition unfolds abruptly or gradually, the metals market's ongoing realignment demands close attention from investors and policymakers alike. Now, we present the clips from Alasdair Macleod's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
Your question about the gold-silver ratio, I think we're going to see it fall further. I think we'll see it fall quite significantly. I mean, I wouldn't rule out at all. In fact, I would expect it to move back down to around about 50, which has been some sort of average over, really since about 1900, I suppose, or the 1880s. Because it was in the 1870s when silver was no longer, the silver standards, if you like, no longer applied in Europe. The last one being Germany, which went on to a gold standard, I think, in 1873, thereabouts. That meant that the value of silver was then being priced for its next use. And so the gold-silver ratio from that point rose from 15, 16, whatever, on the way up. And of course, it peaked under President Trump in his first term in office at something like 120, and is now about on its way back down again. And this is particularly important because if I'm right about the relationship between gold and precious metals, then we are going to see silver recover very substantially, and not the only one, even measured in gold. Of course, everybody concentrates on silver, because that is if you like, the second most important monetary metal in the absence of fiat currencies. So, you get loads and loads of bulls, if you like. So, pessimists like me thinking, well, if we're going to have a currency crisis, or it's the end of the fiat currency era, then silver's going to come back. I think that will probably fuel some speculation, but I think the main point which everybody is missing is that it's not just silver, but it is all the other base metals which have been suppressed by the fall in the purchasing power of fiat currencies. So much so, they can even quadruple against gold, just to return to normality. And what does that mean if gold continues to rise against the dollar? In other words, the dollar continues to fall, pushing gold dollar values even higher. Well, it means that when it comes to inflation inputs, if you want to look at it in more conventional economic terms, those inflation inputs are going to be very destructive of fiat currencies, horribly so. That's the future, I'm afraid. And what does that mean for bond yields? Well, up, 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 up. And it's got nothing to do with the collapse in economic activity that will happen. That's going to happen. Partly because of the adjustment, but also because of the past history of suppressing interest rates and the accumulation of unproductive debt. They're missing the most important thing, of course, which is against what? Okay, in real terms, but it's already it's already suppressed in gold terms, which are real terms. And then when you put an overlay of a devaluing, debasing fiat currencies on top of that, then measured in those, it's going to, this is a disaster. It really is.
And why do you think it's been suppressed and for so long?
It's a function really of the fiat currency regime that really has been in place ever since 1933-34. When gold, in early 1934, the dollar was devalued by 40%. In other words, the gold exchange rate was raised to $35 from 20.67. That sort of held all the way through to 1971, when finally the expansion of the monetary base, if you like, the expansion of unproductive dollar debt really meant that the relationship at $35 became virtually impossible to maintain. I mean, and bear in mind also that the Americans had reduced their holdings of gold from 1947, 48, from I think something like 21,000 tons, 22,000 tons, down to 9,000 tons in 1971, when finally they threw in the towel on the gold standard, or what sort of passed for a gold standard. And since then, we've had a fiat currency. It started off with the US Treasury going on a propaganda campaign saying, gold is no longer the, if you like, the standard. We went from a fixed exchange rate regime to a floating exchange rate regime. The dollar was the king currency, okay, and it sort of got to the point where this rubbish, this propaganda was so believed that they were even describing gold as a pet rock. It's no longer part of the system. But the interesting thing is that now nobody's talking about gold at all. We just don't want to talk about it. We don't want to talk about it. But as I say, I mean, you can go back to the Emperor Diocletian, who introduced an edict of maximum prices. It was around about 270 odd or 300 AD. I mean, a long time ago, 1,700 years ago plus. And you can look at those prices. Okay, the slave markets no longer operate, so there's no comparison there. But you look at things like, beer, wine, clothes, all these things, they're similar price today, measured in gold. The thing that's changed, of course, is that currencies come and go. And every one that comes goes. Because what's currency is credit. And eventually, the credit becomes worthless, or it becomes questioned, and it has to die. That's what happens.
The pricing of base metals relative to gold has historically exhibited long-term stability, but this balance has faced significant disruption during key economic periods. During the 1950s and early 1960s, for example, the rapid expansion of US dollar credit created tensions within the fixed gold price system, which was set at $35 per ounce. This divergence led to both dollar prices and gold prices rising concurrently, ultimately contributing to the breakdown of the Bretton Woods system in 1971. Since the end of that era, while base metals and silver have increased in nominal dollar terms, their valuation measured against gold remains markedly suppressed. According to Alasdair, this indicates substantial upside potential for silver and other base metals to appreciate significantly in gold terms, with projections suggesting the gold-silver ratio may decline toward historical norms near 50. This evolving dynamic underscores the broader impact of ongoing fiat currency depreciation. As the purchasing power of paper currencies deteriorates, silver's role as a monetary metal is poised to strengthen, reflecting rising inflationary pressures and systemic monetary risks. Alasdair highlights that conventional commodity analysis, which is predominantly focused on supply and demand, fails to account for the profound influence that currency debasement has on metals pricing. The anticipated decline in the gold-silver ratio represents not only a reversion to historical valuation, but also a critical indicator of weakening fiat currency regimes. In this context, investors and markets are increasingly recognizing the importance of precious metals as a hedge against currency instability.
The purchasing power of gold is relatively constant. Now, obviously, individual commodities, some will rise and some will fall. There will be differences, if you like, because of in demand and also supply, new mines and mines being exhausted and, fashion, or if you like, new technology moving on into other materials. So you'll get all this sort of evolution, if you like, going on. But if you take a sort of a basket of base metals, then quite obviously there is a level where those base metals will be priced in gold relatively constantly over time. Now, there can be some variation of that. I mean, in wars, for example, and also in the 1950s, when there was some significant strains, 50s and early 60s, there was some significant strains as the dollar was being expanded. Dollar credit was expanding very, very rapidly, yet it was stuck on a gold standard at $35. The result of this was that prices rose, but because you had that $35 relationship with gold, between the dollar and gold, it meant that as prices rose in dollars, it was taking prices up in gold as well. And so we got to a point where prices have risen by roughly 150% on two occasions. The third occasion when this happened was in 1970, and that led to the breakdown of the Bretton Woods system. I mean, this is, if you like, one of the things that you see, if you like, in when the system is under strain. Now, what's happened, of course, is that with the purchasing power of the dollar falling and falling and falling since the end of the Bretton Woods, we now have a situation where the purchasing power of the dollar has gone down, which means that the price of precious metals has risen, but they have not risen enough to reflect the fall in purchasing power of dollars. What we have as a consequence is we have, if you like, take the 1900 price, which actually held pretty much all the way through to the early 1930s for an index of base metals. That has now fallen by something like 77% from that 1990 level, measured in gold. We go back to the long-term purchasing power of gold being constant. Now, this tells us that it's not gold, if you like, that is too high. It's base metals, which are too low, measured in gold. They will recover measured in gold, and they've got the potential to increase by some 400% in gold alone. Now, what does that mean in dollars, fiat dollars? It means that the increase in fiat dollars is likely to be considerably greater than 400% for an index incorporating a wide range of base metals. So commonly we think in terms of inflation rather than the debasement or the loss of purchasing power of the currency. But what it means is that we've got huge, huge drivers of inflation in the background, which are just beginning maybe to come through. And of course, the Keynesians find that this is something they just don't understand because they just think in terms of supply and demand. They don't think of in terms of any variation of the purchasing power of a currency other than maybe modified by the retail price index or the consumer price index or whatever. And consequently, they think that, and having got rid of Say's law, which is what Keynes did back in 1936, they think that if you get a fall in demand, then that means that commodity prices are going to go down. They will get a horrible shock when they find that commodity prices start rising as our economies go into recession or slump. That, I'm afraid, is the outlook. And it's an outlook made far worse by the risk that we see for fiat currencies as foreigners and increasingly domestic institutions begin to latch on to what actually drives interest rates, and that is the risk of an investment and the currency it's denominated in. And they see those risks rising. This is not going to be good. So that, I'm afraid, is the outlook. And it's very good for gold in the sense that gold prices will appear to rise and rise and rise. But of course, it's not so much gold rising. It's the value of what you measure it in collapsing. And I think that we're seeing this beginning to accelerate. And this has become a lot more obvious in recent days. And I don't know about what you're finding, Alasdair, but I find a lot of media, for example, a lot of people that I've talked to are beginning to see that these are problems in the future. They're beginning to wake up. They haven't fully woken up at all by any means, but you can see that there's a sort of, in aggregate, I think what markets are doing is saying, we just can't analyze this, so we're not going to do anything. So you're seeing equities, which are at the top of the largest bubble in history. And I would argue this is greater than anything we've seen before, far larger than anything that we've seen in history in terms of credit. This is extremely dangerous. And I think that the collapse that we're likely to see in equity values, the rise in bond yields, so the fall in bonds, the bankruptcies and all the rest of it, it's all there. And there's nothing anyone can do to stop it. There's no political mandate to even address it. We have governments, who sort of, they are completely unaware of the debt situation. Or if they are aware of it, they daren't even mention it in public. It's verboten. This is I think, a very dangerous time, very, very dangerous time for all G7 nations.
In the coming years, the precious metals market is likely to experience a significant transformation driven by the persistent weakening of fiat currencies and escalating inflationary pressures. Silver, in particular, may undergo a dramatic revaluation as investors seek protection against currency debasement and economic uncertainty. Traditional assumptions that commodity prices fall during economic downturns could be challenged, as metals begin to behave more like monetary assets rather than mere industrial inputs. This fundamental shift may result in sharp and sustained price increases for silver and other base metals, particularly when compared to weakening paper currencies. As confidence in fiat money erodes, precious metals could regain their historic roles as trusted stores of value and safe havens, potentially reshaping the global financial landscape and signaling the dawn of a new monetary paradigm. Do you see gold and silver continuing their upward trend as a reliable safe haven asset, or do you expect market factors to create volatility? Share your thoughts in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.